There are 904.8 million XRP locked inside spot ETFs right now, nearly double what was locked in January, while the price has fallen over the same stretch. That's a real documented divergence between institutional accumulation and price action. There's also a wallet distribution chart getting passed around as proof of an imminent breakout, and a 5 straight green Julys claim that's true, but missing the one detail that actually explains it. Let's sort out what's data and what's just a chart with a story attached. This isn't financial advice, just educational content. Do your own research before making financial decisions. If this kind of breakdown is useful, hit like. It helps the channel reach more people. Let's start with the ETF data because it's the most concrete and verifiable thing here, and it's genuinely more interesting than the round number win rate stat that usually gets repeated. The 7 US listed spot XRP ETFs, anchored by Rex Osprey's XRPR, Bitwise's fund on NYSE Arca, Franklin Templeton's XRPZ, Canary Capital's XRPC, Grayscale's GXRP, and 21 Shares TOXR collectively manage somewhere between $1.0 and $1.4 billion in assets, depending on the data cut, with roughly 904.8 million XRP tokens held in custody across institutional custodians like Coinbase and BitGo. That custody figure has climbed from approximately 478 million XRP in January 2026 to over 900 million by June, nearly doubling in 5 months. May was the complex's strongest inflow month of 2026, with not a single day of net outflows recorded, an achievement no other altcoin ETF category matched that month. Cumulative net inflows since the November 2025 launch have pushed past $1.4 billion. Here's the part worth sitting with directly. Over that same window, the XRP price slid into the $1.16 to $1.25 range. Inflows accelerating while the price falls is a genuine divergence, and it's worth being honest about what that divergence does and doesn't tell you. It tells you that a growing pool of capital is choosing to hold XRP through ETF wrappers despite the price weakness, which removes that XRP from open market circulation. It does not tell you when or whether that accumulation translates into upward price pressure because that depends on future demand meeting a fixed or shrinking available supply, a mechanism that takes time to play out and isn't guaranteed to play out on any particular schedule. Treating inflows are rising and price is about to rise as the same claim is the mistake to avoid here. They're related, but they're not interchangeable. Once you separate the ETF custody numbers, which are audited and verifiable, from the price target someone drew on a chart, you start noticing how much of this conversation is actually two different kinds of claims wearing the same outfit. It's also worth noting where the demand is currently coming from. Reporting through May indicated that retail investors accounted for roughly 84% of XRP ETF inflows, with the larger institutional capital many analysts expect to follow still described as waiting on regulatory clarity, specifically the Clarity Act, before committing at scale. That's a meaningful distinction. The current inflow streak is real, but it's largely a retail-driven phenomenon so far, not yet the institutional wave that would represent a structurally different kind of demand. Now to the wallet distribution data, because the underlying numbers are checkable, even though the interpretation layered on top of them deserves scrutiny. The XRP rich list does show a heavily skewed distribution, with millions of wallets holding very small amounts and a much smaller number of wallets holding meaningfully large positions. That's a real observable fact about the network. What it doesn't tell you on its own is anything about future price direction. A skewed wallet distribution is common across almost every cryptocurrency, partly because exchanges, custodians, and test wallets create enormous numbers of small or dust level balances that don't represent meaningful individual investors with conviction. The honest read is that this data describes the current ownership structure of the network. It is not by itself evidence that price is about to move in any particular direction, and treating few people currently hold the asset as a bullish signal requires an additional assumption that adoption is coming and will be significant, which is a separate claim that needs its own support rather than being smuggled in through a wallet chart. Now, let's address the July seasonality claim directly because it's true in its broad strokes, but it's missing the specific detail that actually explains the pattern, and that detail matters for whether you should expect it to repeat. XRP's long-term seasonality data does show July as one of its strongest historical months, with positive average and median monthly returns going back over a decade. A pattern unusual enough that it's not likely to be pure coincidence, but the specific years cited as evidence deserve a closer look. July 2023's strong performance wasn't generic summer seasonality. It was driven by a specific dated event. Judge Annalisa Torres's ruling on July 13th, 2023, that programmatic XRP sales on public exchanges didn't constitute unregistered securities transactions, which sent the price from roughly 47 cents to 81 cents in hours. That's not seasonality. That's a court ruling landing in July by circumstance. Similarly, July 2025 saw XRP reach a cycle high near $3.66, but that occurred alongside the broader market structure and ETF anticipation building that year, not because July inherently does something to crypto prices. The pattern of summer strength following weaker spring performance is real across multiple years. 2020, 2021, 2022's Q2 crash followed by Q3 recovery, 2024's Q2 weakness followed by Q3 strength. But at least one of the headline years used to support this pattern was actually driven by a specific legal catalyst that happened to land in that month, not by the calendar itself. The honest framing is there's a real historical tendency worth noting, and at least one of the strongest examples of it has a documented cause that isn't seasonality at all. Now, let me address the RSI divergence framework, because it's a legitimate technical analysis concept worth explaining accurately, separate from whether any specific instance of it should be trusted as predictive. Hidden bullish divergence is a real named pattern in technical analysis. It occurs when an asset's price prints a lower low, while a momentum indicator like RSI prints a higher low at the same time, suggesting that downward momentum is weakening even as price continues falling. It's a legitimate concept that traders across many markets, not just crypto, use as one input among several. What it isn't is a guaranteed reversal signal. It's a pattern that sometimes precedes reversals and sometimes doesn't. And treating its mere presence as confirmation that this is how macro reversals are born overstates what the pattern itself can tell you. The same is true of any specific RSI threshold being treated as a hard line between bearish continuation and bull market expansion. Thresholds like that are useful heuristics for traders building a framework, not laws of how markets behave. Let me close with the honest synthesis. The ETF custody data is real, audited, and the most interesting part of this entire picture. 904.8 million XRP locked, nearly doubled since January, accelerating even as price fell into the $1.16 to $1.25 range, an actual divergence worth tracking. Most of that current inflow is retail driven rather than the institutional wave many are still waiting on. The wallet distribution chart accurately describes current ownership concentration, but doesn't, by itself, predict future price movement. July's historical strength for XRP is real as a statistical pattern across a decade plus of data, though at least one of its strongest supporting years, 2023, was driven by a specific legal ruling rather than the calendar. And RSI divergence is a legitimate, well established technical concept used appropriately as one input among several rather than as a standalone prediction of where price goes next. None of this requires picking a side on where XRP's price goes this summer. It requires being honest about which parts of this conversation are documented data and which parts are a specific person's read on what that data means, because those are two different things and they deserve to be labeled differently. Which of these threads do you think deserves more attention than it's getting? The ETF custody divergence, the July seasonality nuance, or the wallet distribution interpretation? Drop your take in the comments. If this gave you a clearer picture of what's actually data versus what's a chart with a story attached, go ahead and like it and subscribe for the next one. Share it with someone who's been told the wallet chart alone proves a breakout is coming. The ETF inflows are real and they're growing faster than the price. The wallet distribution is real and it shows what it shows. None of it tells you where the price goes next week. And anyone who tells you it does is reading a different chart than the one that's actually there. Stay informed, stay positioned. I'll see you in the next one.